Hello, good morning. I'm Kirill Ilinski, I'm managing partner of Fusion Group. Welcome to the third episode of our webinar series. In previous episodes, we hosted guests from Vanguard and AQR who talked about factor investing and quantitative investing, and with particular focus on managed futures. If you missed any of these episodes, you can find them on our YouTube channel. Just type Fusion Asset Management, it will give you a page. Today we will speak about a subject which everybody talks about, artificial intelligence. And we invited Thomas Hartmann-Boyce from ARK Invest to talk to us about investment themes linked to artificial intelligence and robotics, and a little bit about the product which we're using in our portfolios. And I will leave to James, who you already know from previous episodes, to talk about how we utilize this fund and what role it plays in our overall investment thesis. But first, I want to talk a little bit about ARK Invest. And it's not only exciting investment story, it's also, for me personally, it's very interesting business story. So the firm was set up by Cathie in 2014, and now it's one of largest active ETF managers in the world, which is amazing story from a business perspective, because alongside with ARK Invest, there are Goldman Sachs and State Streets and firms with hundreds of years of history, and to be in this position, the top 10 within more or less 10 years, it's an amazing achievement. So it's a pleasure to welcome Thomas to our series, and hopefully he will tell a little bit about how the firm managed to achieve this position. So now you can't avoid it. You have to use it. You have to talk about it. You either love or hate it from point of view of investment management. And we, being protective and investment manager and with protective DNA, we are just too quick to see the bubble, and we want to talk about that in this podcast. So please welcome Thomas, and let's find out what the best investors in this space think about the space.
Well, thank you again for the warm welcome, the introduction, and of course the opportunity to discuss what I believe to be one of the most relevant topics in the investment landscape, and that is artificial intelligence and innovation, and of course the investment opportunity in today's landscape based off all the dynamics that I'm sure you're paying attention to. One way to frame the conversation is to think about this investment space first from the top-down perspective. So what technological advancements are happening? How do we at ARK kind of model and follow those advancements? And then ultimately, how do we form the investment opportunity around those advancements? And I'd like to start by defining really the investable landscape through this concept of innovation platforms. And innovation platforms really lends itself to general purpose technologies, if you are familiar with that term. And it is really a way to kind of risk mitigate the stage at which you are investing and tracking a technology by assigning these three characteristics that you see on the page here, with number one being the most important. So for an innovation platform to be an innovation platform, you need that innovation or technology to be experiencing really steep cost curve declines that ultimately open up adoption, right? Because if you are seeking to invest in a technology, you want to make sure it's investable over an appropriate time frame. So at ARK, for example, we are looking at the cost declines associated with technologies over a 5-year time frame. Anything beyond that might not make sense from an investment perspective. And anything much shorter than that, chances are you're already in the kind of the heart of that innovation moment. So it's really finding the sweet spot in terms of opportunity here. And I use the term risk mitigant. If you were to look at, for example, cost declines associated with the late 90s, early 2000s, you would have seen that there's lots of capital chasing very few opportunities and far too soon. If you look at the depiction on the page, again here, you were at those earlier stages of those cost declines. And where we stand right now across innovations, including AI, and I'll give you some statistics to wrap your head around this, is really at that steep cost decline moment where, for example, you're seeing AI training costs decreasing at around 75% per year, cost to infer 85 to 90% up. And again, these types of cost declines ultimately unlock adoption. And in doing so, and again, in the heart of this definition, innovation platforms, we're looking for technologies that aren't having a sole or discrete or a niche impact on a single sector, but rather an impact to multiple sectors, really having kind of this whole industry-wide impact, and technologies that can really further additional technologies. So when you hear this term platform, again, here it's the concept that there can be S-curves feeding S-curves, or to give you a more concrete example, AI, not just in terms of hardware and data center, right, but AI feeding the autonomous mobility opportunity set, AI feeding advancements in healthcare. And it is really, again, the combination of these three factors that's important in terms of understanding where you are in a technology cycle, and again, ultimately where it is most investable. And I'd say, again, to kind of give you the punchline here, number one is the most important, because again, you want to make sure that there are really material, kind of tangible cost declines happening across technology. And when you run this type of analysis, which really forms the top-down portion of our investment process, it unearths these technologies that you see on the page here. So to give you a sense here, right, in terms of cost declines, for every single one of these technologies, we are modeling these cost declines to, again, understand how attractive these adoption curves are. And the cost declines are important because it's not simply the ability for these companies to cut costs, but it's the ability for those companies to pass those cost savings on to consumers. And one example I'll use here as we walk through this convergence sphere, if you will, is autonomous mobility. And you can look at EVs as the primary example of this. The costs to produce a battery pack system are decreasing at around 28% for each cumulative doubling. So another way to think about this is for every 2 to 4, 4 to 8, 8 to 16 in battery pack systems produced, you see a consistent decrease in cost. And again, why does that matter? It means the auto market, specifically EVs, is going to open up on a relative share basis as these lower cost vehicles come to market. You might have seen most recently, Tesla announced just last week that they're going to launch a new Model Y low cost. Certainly, if you look at the Cybercab opportunity set, it's centered on having a lower cost vehicle. And I think really the case in point here would also be a name like BYD, right? In terms of producing these really amazing vehicles at quite low cost points. And I'll give you one more example to really paint the picture here before talking to the convergences that you see. And that would be in the gene sequencing space. So when you see kind of multi-omic technologies here, we're talking DNA, protein, RNA, et cetera. So it's not just a genomic, it's a multi-omic space. If you look at the cost to sequence the first human genome in 2003, it cost around $2.7 billion, took around 13 years. And going back to my point in making comparison to the late 90s, there was this concept of precision medicine back then, but the technology wasn't there yet from a cost decline perspective. You fast forward to today, now you can sequence the human genome for just about $200 in the matter of a couple hours, right? So these technologies are certainly kind of tangibly advancing, and you can monitor and measure these advancements, again, based off looking at these technologies. And the point that I would make here on this page is that these technologies aren't just advancing in isolation, they're really feeding each other. And I was talking about EVs and autonomous mobility. That opportunity set, call it robotaxi commercialization, is really the combination and the convergence of neural networks, i.e. the AI capabilities really behind that technology. It is the EVs, like I was discussing, the battery pack systems, and it is, of course, the robotics angle. And it's that, again, that convergence of these different technologies that are unlocking all of these different opportunity sets. And this depiction on the page is really a depiction on our modeling and the interconnectivity based off these different technologies. And again, if you think about how to approach the market, I would argue a really good way to do this would be to have an understanding of these technologies and then look for names that are looking to be enablers, kind of leaders or beneficiaries based off these technologies. And I think when you look at the public equity markets in particular, I think you would agree there's been this I guess for lack of a better word, a success with passive investing, with benchmark investing, which is really backwards looking in nature, tends to be a really efficient way to get core exposures over time. But what it often misses is the kind of new names that are on the rise and really seeking to become winners in these different environments. And they tend to, enter benchmarks late in the game, but at a very high velocity. And you've seen that over the last couple of years, really, as these names have come to market. And my point here is that on the growth side of the spectrum, in terms of technology, where these assets sit, it tends to favor a more active picture where you are, again, looking at these technologies, having that as the lens for your investment universe, and then finding names most associated with those technology platforms. So again, to kind of summarize this point, our view is that you really need to have an understanding of where these technologies are headed based off the cost clients to get a proper understanding of commercialization, and then form the portfolio around that. And as you know, at Fusion, ARK has a focus in particular on AI and robotics, which will be the heart of my comments today. But you can see very clearly on the slide here that neural networks and AI, really what's depicted in purple here, is driving the opportunities across these other technologies and opportunity sets. And I'll dig into that through the next couple of slides. So here, my goal is to really talk about where AI is today from a technology lens, and then we'll get through, as we go through the presentation and Q&A, talk a little bit more about what this means from a markets perspective. So the first point I'd make is that, again, these technologies are inherently deflationary in nature. And I know there's lots of discussion around the cost for these large language models as they expand. And we're now sitting at, based on many estimates, over 1 trillion parameters in certain models, whether it's OpenAI or other kind of leading large language models. So these are certainly very expensive, large models. But ultimately, you're seeing massive cost declines if you look at the performance of these models. And on the page here, we have two exhibits that seek to underscore that point. So for example, the kind of low-hanging fruit for large language models has, to a certain degree, been the ability to autonomously code. You've seen it with the Replits of the world, Lovable, a few other platforms where if you can speak a human language, right, you can code. So you can think about it as kind of large language programming as opposed to processing, where, again, you speak a natural language, you can code because you can use these platforms with prompts to generate code. And this is already happening at great length, and I'll give you some statistics as I go throughout today. But on the left side of the page, you'll see here that for coding tasks that achieve a score of greater than 50%, a way to think about that would be they're able to kind of accomplish 50% or greater of their kind of objective or task based off autonomously coding. you're seeing the cost to produce that code decreasing, really rapidly. And the stat you'll see on the page here is end of last year, the costs for this were around $26 and change in terms of the cost per million tokens. And if you look at the number you see on the page here, 35 cents or less, I think the more recent estimates are even down to 25 cents. And what this really means is the AI ecosystem is really being unlocked for more players to get involved here. And again, in terms of performance, you can see on the right side of the page, these models, despite some folks not looking at these kind of coding benchmarks or metrics, these models are moving very quickly in terms of their ability to A, not just complete code, but B, to produce things at a high intelligence. And what I mean by high intelligence is, if you go back a couple of years, you're probably operating in elementary to kind of high school level performance, and now by many measures you have kind of consultant level or PhD level, depending on the model, with reasoning models that are out there. And again, it is this adoption of AI based off these cost declines and increase in efficiency that we think the market in general is starting to grasp. There's lots of upside based off these dynamics, and more companies integrating these types of models as they improve into their businesses and as costs decline. And I'll just tag on one additional comment here. When DeepSeek happened in early 2025, you might recall it spooked the mega cap names in the market in general. There's about $1 trillion in value lost in just the span of a couple hours. And our view was, this could have been anticipated, because if you were out researching this field as we were, DeepSeek was not a secret. But B, again, costs declining by these very high rates is again a net positive, because it means more folks are going to get involved in the ecosystem. And if you look at the cost to infer a model, so not to train, but to infer a model, by DeepSeek's estimates, so you can take them with a grain of salt for various reasons, but 95, 98% decrease in cost for inference. So again, this is, in our view, certainly a net positive for the entire AI value chain, which again, we'll discuss in more depth. But one point that I think is arguably even further under researched or less known is the agentic space of AI relating to commerce here. And this slide is just a couple months old now. And there's been additional developments in terms of new context protocols that have been launched. But this term model context protocol has really been birthed by Anthropic. And it's a way to put, you can think about it as an agentic layer between large language models and e-commerce companies, such that agentic AI can do lots of kind of shopping in this particular example on behalf of folks like you or I that are using these agentic models. And this space has historically been incredibly fragmented. If you look at the internet era component of the left-hand side, and having this kind of agentic layer, in my view, is really going to increase the ways in which these companies target individuals, but also increase the kind of the conversion rate for those customers to effectively purchase, and to make this all as frictionless as possible. And like I said, this is a few months old now. There's a recent protocol launched by OpenAI, and you've seen partners with Shopify and other apps that are now being built into OpenAI and ChatGPT. Go check that out if you haven't. But the point here again is that the entire kind of infrastructure from a software lens is being built around this agentic opportunity very much in real time, and the results are starting to show. And one example of this is companies that are really leaning into AI versus more kind of traditional legacy retailers. And certainly Walmart's making some initiatives to try to keep up here. But if you look at the algorithms that Amazon's running, they're changing prices 2.5 million times per day based off all kinds of different signals that come in, based off their models. And it's this kind of flexibility that we think will really drive companies, and Shopify is being a leader in this space in terms of, again, increasing adoption, but ultimately increasing conversion. And I think it's a space to certainly monitor because just in the last week or so, more and more announcements have come out. Now this space, and in a second, I'll give you kind of the overarching view in terms of the value chain, so to speak, across AI. But this space, I'd say, is probably, again, underrepresented in portfolios. And when folks think about kind of robotics, often they're thinking that this is a separate category to AI. Again, from a strategy perspective, we think about AI and robotics and the convergences that exist. A good way to think about robotics in this space is embodied AI. And that is really AI applied to the physical realm. And I would argue the biggest project out there is probably autonomous mobility, could be a $7 to $10 trillion revenue opportunity. And the reason why that's the case is, again, if you look at cost declines, the ability to lower your ride-hail service from, today the Ubers of the world charge kind of $2 to $4 per mile, if not higher, based off surge pricing, to as low as, and this is kind of more of the bull case, but to as low as 25 cents per mile, based off a few factors, like I mentioned, cost decline, also kind of speed, and importantly, safety. And there's this kind of virtuous circle where there's this feedback loop. As you train models, they get better and better. More folks are willing to adopt those models or to test full self-driving. It makes the models inherently better, and then you have more users. And it's that kind of flywheel that really leads to incredible products. And you're already seeing that again from Tesla's FSD, which rolled out really this year from a commercial perspective in Austin in June. And we expect it to ramp up quite materially. And again, the safety data is there, and I'm happy to talk to that. But again, this kind of embodied AI opportunity set, we think, deserves a space within clients' portfolios. And going back to what I was talking about in terms of kind of niche versus general purpose technologies, this isn't simply ride hail. It's also autonomous trucking. As one example, it's drone delivery. So it's this entire ecosystem that is opening up, and there's kind of many players involved. But we think that when you again assess the AI value chain from kind of the hardware to the software side and then to the embodied side, use that top-down framework, you can really unearth names that may not be owned in certain indices and as such certain portfolios. And our view is that, again, these advancements are happening very quickly, and it makes sense to kind of re-underrate clients' exposures to these different areas. And this is that, again, value chain that I'm speaking to. And I think it's helpful to contextualize this a bit. If you look at the indices, like I mentioned, or even, maybe peer AI funds that could be active, but chances are they're quasi-active in the sense that they manage around a tight tracking or a budget to those indices. These indices or portfolios tend to be very concentrated in the Mag 6 exposure, and I'm sure we'll talk about that at length when we go through the Q&A here. But our view, again, is if you do this value chain analysis, and if you're not simply backwards looking, you're trying to look forward to find the winners in these different areas, it tends to lead to this analysis where there are pockets of opportunity across this value chain from hardware to software and to embodied AI. And a way to think about this would be, and going back to my comment here, a lot of funds are just going to be the Mag 6 and the top 10. They're going to overweight Nvidia and maybe Google and these other names. There's no mistake. These are very exciting opportunities. We continue to have faith in those opportunities doing well from a return perspective, from a revenue and earnings perspective. But you probably already own those names 10 times over, and you're probably, frankly, already kind of stretching your risk budget in a handful of names, whereas other names across the AI value chain, and I'll delineate in a moment, may have a higher opportunity set from a growth perspective, but also B, and arguably carry a lower risk because you're not owning these names in the rest of your portfolio, so they tend to be kind of a diversifier. And a way to delineate this chain here, and I'll give you some examples, would be, again, this hardware to AI platform kind of sitting in the middle to software. And AI platforms, you can think about that as kind of infrastructure as a service. So CoreWeave is a name that's increasingly gained some attention. It's been a name that we've been invested in at a decent weight. It is the Palantirs of the world. And, we can talk about Palantir and valuation potentially, and that is one of the reasons why it is not the top holding in the portfolio. We've continuously trimmed that name. But if you think about AI platforms as really being the entry point for government entities, organizations, and businesses into AI in terms of incorporating them directly into their business models, and then again, seeking to increase efficiencies and kind of reap the benefits of those technologies, Palantir has been kind of the poster child for that space. And you also have, as you dip further away from AI platforms, down a bit further the value chain to software as a service, I think that's also an area where arguably there's probably a bit too much hype in that area, where a lot of software as a service companies are raising their hand saying, look, we're incorporating AI in some unique and market leading way, when in fact I think many are trying to keep up with the Palantirs of the world. So our view again is that within the software as a service, many names that claim they are working on AI might not have the in-house expertise, and it's an area to be cautious. So on a relative basis, we are actually underweight software. And then again, this embodied AI component that we think that the market may not fully be picking up on. So investing across that value chain is important. And so that is the very quick picture in terms of what's happening in the AI space. I think at this point, I'll probably pass it over to James, and then we can talk a bit more about the strategy itself.
So we decided to include the artificial intelligence and robotics ETF within our Optima range of MPS portfolios. So that's our portfolios which are constructed using exchange traded funds. And obviously this fund is an ETF. And that's one of the nice parts about being able to use ETFs in the portfolio construction as opposed to mutual funds, is that you can capture some thematic plays and sort of funds or themes which are newer to the market, new themes. ETFs tend to come along and capture that space and allow exposure much more quicker than in the mutual fund world. And that's exactly what we've seen in the AI space. So the fund, the ETF, sits within our alternatives bucket. And essentially, we decided to add it into the portfolios for a thematic play to capture the momentum which you've been seeing in the AI theme. And we decided to include it in the alternatives bucket because, as Thomas mentioned, we've seen some nice properties of the fund, and that it has possibly some diversification benefits and some low correlations to traditional growth style portfolios. We decided to add it with a small weights in a sort of a more satellite approach to include it in the portfolio. So it sits nicely alongside our core portfolio with a small weight in the alternatives bucket. And our goal is for it to deliver outsized returns as it has done previously in a scenario in which the AI theme continues to generate outsized returns. Obviously at Fusion, we have a focus on protection, which has been one of our core sort of principles over the years, over our long 20+ year history, and it's now one of our focal points in our model portfolio service and our MPS portfolios. So we decided to combine this, if you like, this aggressive portfolio holding with also some positions which will aim to capture returns if that scenario doesn't quite play out in the way that we'd like to see. So alongside this AI thematic fund, in our alternatives bucket, we've also added a VIX position. And this is a fund which essentially tracks the VIX index and makes money when volatility spikes in the markets. So therefore, it's a sort of a straddle type strategy, so that in one scenario, if AI continues to win, we'll capture those outside returns. And in a different scenario, if that situation doesn't quite materialize and markets sell off. We'll have our VIX position, which will capture that downside as well, and therefore we'll add a layer of protection into the portfolio. And as I mentioned, one of the characteristics of the fund, the ETF that we're talking about today, that we like is that it has a low correlations with other asset classes. So within our alternatives bucket, predominantly we're looking for strategies or asset classes which have low correlations with equities and bonds. And the fund that we're talking about today has a low correlation with the value strategies within equities, as well actually a negative correlation, which is a nice effect. And then also reasonably low correlation with growth style strategies as well. And Thomas, I'll hand back over to you, and it would be interesting to know about how you achieved that low correlation with traditional growth style equities, even though quite a lot of the holdings that you're holding in the fund are actually growth companies.
Yeah. First of all, I think you're thinking about the strategy in exactly the right way. So many of our clients actually tend to be downside focused and kind of value leaning investors, but they see this as certainly a really good complement to the rest of their portfolio. So to your point, right, you are getting kind of a dedicated high growth AI pure play with this portfolio and these names that can complement on your existing exposures given the low overlap, just like you're articulating. And to give you a stat here, if you look at our active share, so it's a form of measuring how active you are relative to the NASDAQ 100, given that we're benchmark agnostic, we have a 77% active share to the NASDAQ 100, which again is quite high. If you look at a lot of kind of peer-oriented funds, that active share is going to be typically significantly lower. And as a result, you're really not getting that diversification that you're probably seeking to add to your portfolio. And to your point, how do you get this diversification? We don't have a portfolio objective to target something like a 77% active share, but it's more a byproduct of our investment process.
So yeah, thank you for painting a very compelling story and an argument for the AI investment case. We thought it would be interesting, particularly for the Q&A section, to pose you some questions as perhaps skeptics of AI and the AI theme. We've been seeing a lot about in the media about maybe an AI bubble. Getting questions from investors. Is this the time to maybe exit the theme? So that's kind of along the lines of the questions which I'm going to be posing to you. So we've read lots of articles on the economics of the Capex, the capital expenditure of the AI sector, which maybe paint quite a rather negative outlook for the sector as a whole. So I'll give you an example of some of the things which we've been reading. So one article focused on 2025 data center spending alone versus the revenues. And this was an article by Praetorian Capital. So it said that the total data spend for 2025 would be in the region of $400 billion. And then if you assume, say, a 10-year depreciation curve, that's $40 billion of annual depreciation. Sure. While the firms are currently generating somewhere between 15 and 20 billion of revenue across the industry. So the depreciation is literally 2 times the revenue. And then if you look at an optimistic scenario, can these firms grow the revenue to justify the spending? So if you assume an optimistic scenario, margins somehow become positive, they'd need to generate, if you take like a margin of about 25%, they'd need to generate somewhere in the region of $160 billion of revenue to get that 25% margin, which gives you 40 billion of gross margin against the 40 billion of depreciation, which means you need to grow revenue roughly tenfold just to cover the depreciation. And then if you factor in profits, those revenue targets grow even higher. So if you factor in a profit of, say, 20% return on invested capital for the industry, you need about $480 billion of AI revenue to hit your target return. And that $480 billion is an astronomical figure. So in the context of current companies, so Netflix generated $39 billion of revenue in the last year, Microsoft $95 billion of revenue, and both essentially sort of ran out of customers if you look at their numbers of subscribers sort of plateauing. And the problem is that $480 billion of revenue isn't just for all of the world's AI, all of the world's future AI needs, is the revenue required simply to justify the 2025 data center spend alone? So I guess one of the points is there enough revenue, and can there ever be enough revenue to generate the current spend? So I'll be interested in your outlook for, your view on this outlook for the sector.
Sure,
is
yeah.
it inevitable that we're going to see huge sort of Capex write-offs from these companies?
Sure. So I'll spend some time on this question because, to your point, I think this is the most important question to ask. This is the most probably nuanced topic, and it's probably the most relevant in terms of investment management today, right? This is certainly helping the markets rally in terms of the amount of Capex being spent here, but is it sustainable? Will revenues come through, et cetera? So, and by the way, from a risk management perspective, you yourself asking these questions is a really good sign, right? Because technologies tend to go through these different cycles, and it's good to assess where we are in the cycle. So it definitely warrants spending some time here. So thank you for asking such a thoughtful question. I'd answer it a number of different ways. I'd start by saying, well, first, I'd probably question that 20 billion figure in terms of revenue that you quoted. I know it wasn't your calculation, but in terms of the article that you quoted, if you look at the top 2 to 3 AI labs alone, they're probably running at around 20 billion or so in terms of run rate, and that's right now. And that's not accounting for some of the acceleration from a cloud revenue perspective with these cloud service providers. You're seeing double-digit percentage points of growth from kind of Azure, these other players. And again, this is at the high level, and then we'll dive a bit more into these comments. But you're also seeing, many platform as a service, like I was mentioning, and software as a service companies to a certain degree that are growing on top of these AI products. So to a certain degree, if you're just isolating the large AI labs, the open AIs of the world, it's going to get you kind of closer to that 20 billion figure. But as we know, based off what I was describing of this ecosystem and AI really being kind of one of the most profound, impactful technologies from a productivity perspective, and we can unpack that a bit more, I think there's much more room to run. But my second point that I would make is that with all kind of technologies, historically, revenue lag is arguably to be expected. Productivity curves always lag investment. So if you look at kind of railroad, electricity, internet, when these technologies are being built and really being kind of embedded in in their different industries or different regions, there tends to be relatively high Capex that again precedes productivity and monetization. I would argue we're kind of in that phase of large language models where you're in kind of deployment and fine-tuning phase. But the monetization models are accelerating quite quickly. We were mentioning this concept of kind of natural programming or large language programming, and you're seeing that with the revenues coming from the kind of the Replits of the world, the co-pilots, and agentic commerce, like I was mentioning, is kind of starting to catch on. So I think there certainly are some very much real developments, and we are in this, to your point, this kind of awkward environment where the money is being funneled in, and it's like how much is going to really reap the benefits of those investments. And again, if you look at some of these different areas where they're easier to measure the immediate impact, you are seeing that in these different areas. I mean, I'll give you one kind of example, and this is last year or even the year before, so call it the last 18 months. Companies like Amazon, they put out a report themselves stating that based off autonomous coding agents that they've created internally, I think it was called Amazon Q, they've saved $260 million in annual cost savings just in 1 year by using those coding agents, as opposed to having all kind of professional programmers work in that kind of kind of recurrent app development as they roll out the kind of the latest app models. And $260 million, again, those are big savings. That's an individual company, albeit a very big one. But these kinds of cost savings are certainly there. And to a certain degree, you wouldn't see kind of the freeze up in college graduate hiring if this weren't the case. So to give you a sense of ARK's kind of research, if you put our total addressable market on this, we see automation software as being a gigantic investment space really by 2030. That again factors in all these different movements.
Yeah, no, that makes sense. Yeah, I've seen quite a lot of sort of counter arguments to my question to be that the government may step in and provide some of that funding, certainly. My next question is around sort of AI and AI use cases. You mentioned there that obviously now that the technologies are there and we're starting to see adoption in companies and therefore for revenues come through. We've done a lot of reading about different AI use cases, maybe some areas where AI large language models are successful, some areas that they're not quite making the progress that some people would expect. And one sort of central argument to this is that large language models are great at regurgitating information, but they become erratic and begin to break down if you get them to do anything sort of unique or actually intelligent. Sure, yeah. So the classic example is playing chess. Right, you can train an LLM on every chess book ever written, more than you could ever read in a lifetime. But Twitter and Reddit and things like that are full of examples of where these large language models then sort of make illegal moves or could generate new pieces themselves. And again, I've seen cases talk about that AI has only been used, particularly ChatGPT has only been used for homework. I'm not sure if you saw the article which mentioned that ChatGPT usage had dropped 85% outside of the US school and college term times. And obviously there's not that much revenue in homework. And also it can be used to generate code. But I've seen some articles suggesting that there's problems with that code being buggy. You can only generate generic code. Can also be easy to hack. There's also the paper by the Agent company paper, which came out of Stanford University. I'm not sure if you saw that one, which essentially broke down, and this was in the context of AI replacing workers. And it broke down the operations of a software company into 450 tasks and got AI agents to complete those tasks. And the completion rates fell in the range of 1.5% up to about 34%. So only a third of the tasks in the best cases were being completed. And also the task completion wasn't consistent. So the model would complete it once, but then not be able to do it again, which meant that the completion of the task wasn't reliable. And then more recently, we had the MIT report saying that 95% of corporate AI adoption projects are failing. So I'd be interested to see what your sort of counter argument to this would be. Where are you seeing the AI use cases that are really providing value in firms?
Yeah, great questions. I think this is actually easier to provide counterpoints to, because if you look at a lot of kind of facts out there, and if you look at the market, you look at the investment landscape, I would argue that there's lots of areas where you're seeing kind of very real development in terms of efficiency and productivity gains. So I'll walk through that. But nonetheless, I think it's the right question to be asked, because I think a lot of people don't truly understand what AI even is. It becomes anthropomorphized, where you treat it as a human when it's certainly not, right? It's how do you take large data sets, identify patterns, and then create decisions or help guide directions. And in that context, it's almost like an instrument to amplify human knowledge and kind of human ability, right? Which is why it's such a big productivity tool. Now, if AI wasn't working, I don't think you'd see upwards of 70% of enterprises embedding or seeking to embed AI into their workflows. Well, this is, certainly, like I said, this kind of fine-tuning phase. I don't think it's one big massive experiment that the whole world's testing at the same time. I do think you're already seeing some productivity gains, and I'll talk about that momentarily. But a way to think about it is that MIT study, right, the 95%, I would argue it's more of like a pilot fatigue or more poor change management than like underlying viability of AI technology itself. You could just as easily say 95% of like enterprise risk process or CRM transformations failed at one given point. But we all know how reliant we all are to a certain degree, especially from a business perspective on CRM and ERP, right? I think, the best cases in terms of technology uses are the ones that scaled. And for the ones that didn't scale, it's really easy to point out where you see kind of ineffective use cases. So I mentioned the Amazon example above. Palantir is one of our top holdings. So I'll maybe use some of their examples just over from their last report. I believe it was Fannie Mae, where you saw their time to detect fraud decrease from 2 months to just a matter of seconds. I see that as obviously a net positive. Citibank was one of their customers that took their onboarding for new banking clients from 9 days to seconds. In the medicine space, one of their clients saw something like a 2,000% increase in discharge time for, I think this is in Nebraska, don't quote me on that, for some of their clients. So depending on what sector you're in, you're already seeing some of these massive developments. And a way to contextualize things historically would be, I think we're at the point in time where it was like 1995 for the internet. Right now, AI applications have penetrated about 16%, based off estimates from our team, of the smartphone market worldwide. So just like starting to become kind of households, so to speak. And it was about that time in 1995 where you saw this happen across PCs. So again, I think we're kind of early stages there. Now, part of it comes to the kind of utility rates. As these hyperscalers improve and as you see optimization, the GPU utilization will continue to get better and better. And this goes back to what I was kind of describing, this virtuous circle, where as the technology improves, you're going to see kind of more use cases where these numbers improve. And again, picking on that 95% study as well as the Stanford one, if you went back to earlier in my presentation when I was showing you I showed you on the left side the cost declines associated with AI models. The right side exhibit was showing you how effective these AI models are becoming. And again, as they become more and more efficacious, you're seeing more and more direct development into places like drug discovery, et cetera. So again, look at agentic coding, look at legal and compliance, you look at design, you look at healthcare, and there's very much real use cases today. So,
thank you. And you mentioned that as these technologies continue to improve, we might see more benefits to companies adopting them as the models get better and better. So my next question is to do with around sort of a scaling wall, as we've also read some articles suggesting that we might be hit a scaling wall in terms of the capabilities of these LLMs. Mm-hmm. So, for example, ChatGPT cost $50 million to produce. ChatGPT 4 was $500 million. ChatGPT 5 was to cost $5 billion. Mm-hmm. And then OpenAI was actually supposed to release it and then put off the release because some sort of inside scoops from Bloomberg, etc., revealed was that they put it off because it wasn't sufficiently better than ChatGPT 4 to justify the extra expense.
Sure.
And then there's obviously the issue of the no moat issue, I think it's normally called, where it's very easy for competitors to catch up with these models, especially if they're only marginally better than previous models, because within a few months you can use synthetic data generated by the new model at a fraction of the compute to generate the new model. So what's your view on AI hitting a scaling wall? Is this what you're seeing as well?
The short answer is no. I understand these models are getting larger and larger, hence the increasing costs. Like I said, trillion plus parameters. by some estimates. OpenAI doesn't disclose, but if you look at the estimates that are out there, these are large models. That represents this increase in cost. The reverse example would be, and I'm not going to give you exact numbers here because I read this about a year ago, but the equivalent model for GPT-4, like you said, costs something like 500 million. If you were to create that model today, it probably costs less than 5. So you're actually seeing cost declines based off the efficiency. So again, to only look at cost and to remove the efficiency or performative component is a bit disingenuous to how, I guess, favorably the space is moving. I'll answer a few different ways. One is that you could argue, yes, if you're taking a trillion parameters, how much larger can these models get? I think that's a fair argument. These are already very large models, and it's costly to increase them. But like incremental improvements in the efficacy of these models, i.e. removing the hallucinations that you brought up earlier, which is, you can think about it as like a bad result from a model, i.e. increasing their accuracy from like 99.5 to 99.9, just making up numbers there to give you a sense. Is meaningful, right? Because then you can become much more reliant on it and all kinds of things like defense, which is already obviously hugely intertwined. But my point is incremental advancements here are quite meaningful. But going back to number of parameters and kind of data, importantly, more and more data is coming to market. So you could argue, yes, these models are trained on 30 years of internet-oriented data, and that data is running out. And now it's trained on like real-time data, Reddit data, like you mentioned, I think. I'll give you one kind of niche example, but hopefully it helps paint a picture here. I mentioned the cost to sequence the human genome has dropped from $2.4 billion to 200. What I find fascinating is that you can now sequence a single cell in a human body. Each of us has around 37 trillion cells. And that's fascinating because the more data you have, and by the way, healthcare is easily the biggest repository of data. Not including all these new modalities that are coming out, right? So you're going to get more and more, not just data, but high quality data, and you can even have synthetic data to test drugs and whatnot. More and more high quality data is going to be coming out. It's going to be incorporated into these models. So I think really the insights that you're going to reap from these models, and again, going back to efficacy, is only going to increase. So to a certain degree, I understand the point that how much larger can these models get. Truthfully, I think they can continue to get much larger, and it is costly, but this is not, again, for no reason.
Yes, thank you very much. And then finally, I think we've got time for just one more question.
Sure.
We've seen lots of talk in the media, particularly about the AI bubble, with even recently the Bank of England coming out and warning investors of the bubble. Plus, we've seen some activity which could be described as red flags, such as Nvidia's round-tripping deals with other parties in the industry. Should investors be worried, and what's your view, particularly on these round-tripping deals?
Sure. I'll highlight a few things here that I haven't highlighted throughout the conversation. I mentioned kind of deregulation. One point I just make, and this is to the benefit of equities in general, or risk assets in general, but also especially innovation, is if you look at one big, beautiful bill, Ep.3, I know that's an obnoxious name for a bill, but obviously so much oxygen's been taken out of the room from a tariff perspective, rightfully so. That's starting to reverse in the sense that people are recognizing these tariffs announcements as negotiation tactics. But what I wanted to point at is if you looked at that bill, and I think it's section 147. Again, don't quote me on that, but I believe it's section 147. It talks about depreciation. We were talking about depreciation, where companies focus really on innovation, but on growth, can immediately expense R&D, software, equipment, so talk about AI and robotics, right? And manufacturing facilities once they're serviced, and that's if they're serviced within 3 years. The point there is that takes the tax rate from around 21% from a corporate tax. And we all saw what happened with Trump when he took the corporate tax from 35 to 21 in his first term, takes it from an effective standpoint to around 10 to 12%, which makes us one of the most competitive countries in the world from that perspective. And I think people don't know that because it's effective as opposed to statutory. So I want to mention that, because when you think about like the positive response of markets, that's to a certain degree might be one of the tailwinds that's driving everything you're seeing in the space. And to a certain degree, I think that's justified based off how strong that is from a macro tailwind. Now, going back to your question more specifically on kind of this concept of entrenchment, self-dealing, and round tipping, I think it's frankly healthy in the sense that you wouldn't want a single company, not necessarily you wouldn't want it. If a company achieved this, it'd be fantastic from a market perspective, but we know there's anti-monopoly, antitrust types of considerations out there. But you wouldn't necessarily want a company that owned the entire vertical tech stack. Vertical specialization is relevant pretty much every industry. It's certainly relevant in AI. If you think about each company kind of maximizing its corporative, or not just corporate, but comparative advantage. Nvidia with GPUs. On the design front, Taiwan Semiconductor on the manufacturing front, just to name two. Oracle building AI native clouds, Palantir on the AI platform side, OpenAI building models, right? You want these companies working together as opposed to being everything all at once. And having kind of strong connectivity and to a certain degree being kind of proactive in the way these announcements and deals is structured just speaks to the strength of this space. So again, I see it as this Capex coordination as a way to prevent kind of infrastructure bottlenecks. To a certain degree, you're kind of locking in the AI Capex cycles. And to a certain degree, it gives us as investors a better way to map out what's happening. As long as, again, you have faith and an understanding and a way to measure the way in which AI is being actually incorporated into these businesses. A comparison's been made, and I think it's a just one, that if you look at other sectors or other industries like auto manufacturing or it could be kind of the airline industry, it's no different than like Boeing and GE aligning on jet engines for fleet expansion, right? These companies are working together. So this interconnectivity, I think, is probably over highlighted as like something that's unethical. It is just a nature of these businesses being at the leading edges of their field.
Thank you, Thomas. Thank you, James. Very engaging discussion and an excellent presentation. As you see that this webinar is somewhat longer than our typical webinar, just because the subject is new and exciting, and we all need to, it's not a choice anymore. We have to think about it in terms of changing economy, in terms of changing investment portfolios, in terms of changing the drivers. So I hope you found it interesting, and thank you for watching. Next time we will host our colleagues from Research Affiliates, who will be talking about marvels of fundamental weighting in the indices and dangers of passive index investing. Circling back to the subject which we are touching now in every hour webinar, which is how to build portfolios with protective components or protective stance in case of strong market correction. So hope to see you all next time. Thank you for watching. Goodbye.